Nigeria's interbank core rate dropped to 24.5% in October 2025, its lowest level in 11 months, signaling improved liquidity in the banking sector as funding pressures ease. The decline follows the Central Bank of Nigeria's gradual interest rate cuts and adjustments to the cash reserve ratio, which boosted banks' lending capacity. Reduced government borrowing, capital raising activities by banks, and a more stable macroeconomic environment also contributed to the fall. Analysts say the lower rate reflects better monetary policy transmission and may support increased private sector lending. The CBN's recent 50 basis points rate cuts and liquidity management measures are expected to keep interbank rates stable in the near term. We have joining us now to provide more insight, Ayokunle Olubunmi, Head Financial Institutions Ratings. Agusto Co, good morning. It's a pleasure to have you join us.
Good morning. Thank you for having me.
A pleasure. And what would you say this drop in Nigeria's interbank core rate to 24.5%, what does it signal about liquidity conditions in the banking system?
Like you said earlier, we've seen significant improvements in the liquidity position of the banks after the last MPC meeting in September. In addition to the refunds that the banks got from the central bank, CRR refunds, we've also seen that the CBN has reduced the frequency of the CRR debits. Before, it used to be weekly. Now the CBN has returned to bi-monthly debits, so meaning that our debits are done every 2 weeks. So that has provided the banks with a bit of liquidity for them to actually play with, right? The reduced borrowings of the federal government relative to maturity, that has also increased the amount of available funds in the Nigerian financial system, right? That has helped also. Also, the capital raising activities. Banks have raised capital. Typically, although capital shouldn't be used to fund your activities, it should be largely used to provide the infrastructure and the facilities that you need. But what you've seen banks do is that, given the heightened liquidity pressure and funding pressure, some banks have temporarily used those funds to pay down high-cost funds and even to address their funding needs for the meantime.
And how would you say recent CBN interest rate cuts has perhaps even influenced short-term lending amongst banks?
You know, when you're looking at banks, right, in terms of lending, there are a lot of things that goes into lending. Definitely rate is one of it, but that's not the major consideration for the banks. For the banks, the focus is, if I'm lending these funds out, will I be able to get my money back? That's the primary consideration. And if you look at what is happening in the economy, yes, some of the macroeconomic indicators are improving, but you see that the economy is not yet out of the woods, right? So you see that a lot of banks are still cautious when it gets to lending, right? They are not aggressive when it gets to lending. Although rates have dropped, but some banks will rather tell you that, look, I don't even mind still investing in relatively low yield securities rather than lending, because the economy is still hurting. A lot of businesses are still suffering. And the expectation is that in the next couple of months, right, the non-performing loans will actually even increase, because as the pressure that businesses are facing, we are seeing it transmitting into the loan books of banks. So to answer your question directly, a lot of banks are still cautious in terms of lending. The appetite to risk asset creation hasn't really changed, despite the lower interest rates that we're seeing.
Interesting. But we're also seeing lower domestic borrowing from the federal government. Is that in any way impacting liquidity in the banking sector?
Oh, yes. Because now the question now is that, look, right, there are a lot of funds in the liquidity system, in the financial system. And that's why you are even seeing that some corporates are even going to issue commercial papers. There's a lot of liquidity around. If you also look at, apart from even the banks, if you look at the money market funds, right, the asset managers, you see that their AUM has also grown significantly. Because what we've seen is that the federal government the maturities that they are having is much more than the rollover that they are, the new instrument that they are issuing. That actually even increased the amount of funds that we have available. And the reason for this is not far-fetched. The federal government is also trying to manage its It's also the debt servicing costs, right? Recall that debt servicing costs, although it has reduced significantly, but the debt service to revenue ratio is still very, very high. The government is looking at that also. Then we also see that the government is also trying to even avoid crowding out the private sector, right? So that one has reduced the federal government's borrowing, and that has increased significantly the amount of funds that we have in the financial system.
All right, and coming to CRR, how significant is the cash reserve ratio adjustment in easing funding pressures for banks?
Significantly. Like I mentioned, what the CBN has done is to, although so we can think about it that the 50 bips is relatively small, but it's a signaling. The CBN is basically saying that, look, right, we are trying to start the easing, right? The contractual stand is coming to an end, right? And what we've seen is that, like I mentioned, it's not only the 50 bips reduction, the frequency of the debits has also reduced. So before, once your deposit position has grown, every week the CBN will debit you. But now you have a leeway of 2 weeks to have those funds, to actually even use them for what you want to do before you have the CBN debit, right? So definitely, you've seen that the funding pressure for the banks have actually even reduced. You see that the number of banks that are actually at the SLF windows, right? The number has actually dropped significantly. And like you mentioned, right, the interbank activities, right, has also reduced as reflected in the borrowing, right? But what we've also seen is that banks are also using it to pay down some of their high-cost term deposits, right? And then they're focusing more on low-cost deposits.
And we're also seeing improved macroeconomic indicators. The numbers are looking good. Inflation, exchange rate stability. Can that sustain this downward trend?
Because at the beginning of the CBN governor, at the beginning of this administration, has mentioned that, look, the decisions on the CRR, the MPC decisions will be data-driven. And what we've seen over the last couple of months is that, look, right, they've actually even responded to what we are seeing in the economy. So if this disinflation trend that we are seeing continues, if the exchange rate remains to be stable, right, we expect to see further reduction in the CRR, and then definitely that will also improve the performance of the businesses that we are seeing, right? That will also support the bank's lending, and definitely the funding pressure of the banks will actually even reduce, right? Because if this downward trend continues, you will also see that, look, banks will also even be coming to the debt capital markets, either in raising either short-term bonds or long-term bonds. That will also help to even reduce the funding pressure that they have, help with their the balance sheet structure, right, in terms of matching the asset and the liability, and that will also help to reduce the funding pressure that the banks have actually been contending with.
All right, and let's come to the MSMEs, the private sector. And I want to focus on the MSMEs, considering their contribution to GDP and the goal of the $1 trillion economy. How is all this, specifically the lower interbank rate, how is it affecting lending to the MSMEs and the private sector?
Yeah, you mentioned a very important point, yes, because the MSME is like the engine of the economy, right? That's actually what you want to use to drive growth. If you look at the developed countries, you see that the bulk of their of the population, they are employed by MSMEs. Unfortunately, what you also realize that these MSMEs are highly vulnerable to macroeconomic downturn, such that when there are shocks in the economy, high inflation, FAM, exchange rate issues, you see that the first impact are felt by these MSMEs. So that's why you see that a lot of banks are very cautious about lending to this particular sector. Now, having said that, if we are seeing further improvements in the macroeconomic environment, you see that the performance of these MSMEs will even be better. And what we also see is that a lot of banks will be willing to extend facilities to them. Let's not forget that a lot of banks have raised capital. And definitely, if you raise capital, you need to deliver returns to your shareholders. And for you to give returns to your shareholders, you need to also lend. So, and a lot of banks, another major area that they are looking at is the MSMEs. But for them to lend significantly to the MSMEs, the conditions in the economy needs to actually improve, right? Inflation needs to go down. The exchange rate needs to be relatively more stabilized, and definitely we need to see supportive fiscal policies for that to actually even help banks and even stimulate them to lend to the MSMEs.
So we need more policy in that regard. And we've talked about the 50 basis points MPR cut. But then there are those who are saying that it's not adequate for stimulating economic growth. Do you agree?
Now, you know that also, managing the economy is something that is going to be very careful. Like I mentioned, what the CBN did was to first signal that, look, right, they are willing to start easing things, right? If things persist that way, I anticipate that there will be further reduction in the CRR, right? Because what you notice is that it's for CBN to actually even reduce that CRR and then to inject such funds back into the economy, it will be counterproductive, because that can even spike up inflation if a huge huge amount of funds is released into the economy. So we anticipate that there will be further easing, right? And then probably things can also even get better. Some can argue that 50 bips is very small, but at the same time also note that, look, you don't want to release huge funds into the economy at the same time. The economy will not be able to accommodate it, and it will have inflationary pressure.
And speaking of inflationary risk, do you see the excess liquidity, especially from the fiscal inflow, do you see that posing a future inflationary risk in spite of the CRR tightening on public deposits?
Yeah, it's actually a major area of concern. As a matter of fact, some will even argue that, look, one of the reasons why we've not seen the full impact of the various monetary tightening and monetary policies is because of the huge inflows that we are getting from the fiscal side. Don't forget that since May 2023, when this administration came on board, right, we've seen the allocation of the FAC allocation has even tripled, if not more than that. And that have actually been a huge amount of pressure, right? A lot of inflationary pressure have actually even been associated with that. So definitely, yes, they are concerned that the fiscal side, right, they need to also work hand in gloves with the monetary authority to ensure that, look, right, we can tame inflation. Yes, you want to develop infrastructure. Yes, you want to even make the life of the citizenry better. But definitely, they need to work hand in gloves with the CBN to ensure that, look, the inflationary impact is relatively low. And then the risk is also heightened, given that we are gradually moving into the electionary period. And like we all know, as we get close to the electionary period, right, fiscal spending increase with potential impact on inflation.
So a lot of concerns around that, and hopefully relevant authorities, the CBN, has a handle on that situation. But what's your outlook, right? Do you project, especially what outlook do you project for interbank and OBB rates if the current monetary easing continues?
Yeah, of course, if the current monetary easing continues, definitely the rate in those markets is going to actually even reduce further, right? Because definitely, if you ask a bank, no bank will ordinarily want to go to the interbank market to actually even get money. It's when you are under severe pressure, right, that banks actually even go into that market, given the way perception about banks that are actually in the interbank market. So if things continue, if the macroeconomic environment, since if things continue this way, although like you mentioned in the highlights, right, the Trump's threat is actually even something that we need to watch out for, and now we actually even manage it, right? But if things continue well in the macroeconomic environment, if things continue better, we expect rates to drop further, right, and that will also even help the economy further.
All right, let's see how that pans out. But thank you so much for your time, perspective, and outlook. Head Financial Institutions Ratings, Agusto Co. It's been a pleasure. Ayokunle Olubunmi, thank you for joining us.
Thank you for having me.